Hey, what's going on? Welcome to the second segment of my beginner's day trading course. In this segment, we'll be talking about market terminology and candlesticks 101. So let's get started. All right, so market terminology. These are basic terms. We're going to start off with entry. Entry is a price or a level where you start a trade or open a position. In my last videos, I talked about the 3 goals of a trader. So we need to know what direction price is going in, when to get in, right? So get the timing right. And then how long do we need to stay in for exit? So the entry is the win. It's the timing piece, okay? So entry is about getting in at the right time to make money, all right? So then we have exit. So exit is about getting out at the right time to lock in profits or avoid losing too much. And then we have profit target and then take profit. These two are interchangeable. Whatever sounds good for you, you can use either one. They mean the same thing. And the whole point of a profit target is to lock in your profits. Price doesn't always go in one direction the entire time. So if it's going in our direction, we want to go ahead and lock in our profits before it reverses on us and we turn a winning trade into a losing one. Then we have stop loss. Your stop loss is your insurance and it stops you from losing with so much money. It is the point of invalidation when your setup or your edge is deemed invalid. That's the earliest point at which we know that this is not going to work out and we minimize our loss. Then we have the long position. Long position means that you're betting that price is going to go up. This is the most common way to trade, but not the only way. Then we have short position. Short position is betting that the price will go down. So this is how a short position works. This is how you make money with the price going down. So say for example, if I have a stock and that stock is valued at $5, right? So it's $5 per share. And you're like, hey Lawrence, let me borrow that stock real quick while it's at $5. Okay, here you go. So I'll let you borrow my $5 stock. And then you go and sell that stock immediately. So now you have $5, like you already sold it for a $5, conversion, whatever, USD. So you sell it, you have $5, you wait for the stock price to go down to $2. So then you take that $5 that you sold it, you buy it again so you can return it to me, but you bought it at $2 and you keep the $3 difference. And then you just give me the same stock that I had before. And that's how you make money off of shorting and betting that the stock price is going to go down. All right, so moving on. We have profit and loss. So your profit and loss shows how much money you've made or lost in a trade after you close the trade. Pretty straightforward. So then we have risk. Risk have 2 different meanings depending on the context. So the first meaning is the chance of losing money. And then the second meaning is how much money can be lost in a trade, which all comes down to deciding how much money you're willing to lose on a trade. And risk is the most important part of trading because we can't control the outcome, but we can determine how much we're actually able to lose. And that in and of itself is more than enough to win over the long term. Then we have the risk to reward ratio. How much money are you willing to risk or lose in order to make a certain amount of money? By looking at your potential risk or your potential loss and your potential reward, it will determine the quality of the trade. So if I went ahead and placed a trade and my stop loss is $1 from my entry and my profit target is $3 from my entry, that's a 3-to-1. That means I'm risking $1 to make 3. And that's a pretty good ratio. So even if that trade doesn't work out that time, I would take that trade 10 times over and I guarantee you I will win. With a good risk to reward ratio, it actually allows you to afford losses, right? So losses are inevitable, right? Like I said, every system comes with losses just by default. So if you have a 3-to-1, that means every time I win, I make $3. Every time I lose a trade, I lose $1. So if I win one trade, I can afford to lose 3 trades back to back to back and still break even and not lose any money. Or if I lose 3 trades back to back to back, all I need is 1 win to get me at break even and I'm back in the game. So then you have bullish and then bearish. Bullish and bearish are just simply biases. They're not necessarily an action. Like buying and selling is the action. Bullish and bearish is a bias or an opinion on where you think that the stock market is going to go. So bullish means that you believe that the stock market is going to go up, and bearish means that you believe that the stock is going to go down. Then we have trends. Trends is the direction of price. There's 3 directions that price can move in: up, down, and sideways. Trends show you where the market is going and the overall direction of the market. And here's a fun fact. A lot of people, they trade reversal strategies. If you trade with the trend, your odds of winning is so much better than trading reversals. Then we have pivot points. Pivot points are very important. This is a 3-candle formation that will act as a turning point. And the reason why this is so important because it gives you a heads up before a change in direction. So you're catching a trend change in real time. So not only does pivot points help you anticipate a trend change, they also lay out support, resistance, supply, and demand zones. And I'll show you later on in the course what I mean by that. Then we have patterns. Patterns are repeated shapes or moves in price that hint at what's next. Me, I mainly trade patterns. That's all I trade because they're very repeatable and objective, and they normally happen every single trading session. Then we have market structure. That's how price moves through highs and lows. You could think of it as the big picture. Pretty much shows if the market is going up, if it's going down, or if it's like consolidating or stuck in one place. All right, so moving on. I wanted to show you the difference between sell and short and buys and long because they can be interchangeable at times. Like I know that you probably heard like a lot of terminology and people like, okay, I'm selling. And they may actually be talking about closing the position, but sometimes they might actually talk about entering a short position. So sell is closing a trade, right? But it can also be interchangeable with selling, meaning you're going short. And then short is actually borrowing shares to sell now and aiming to buy them later at a lower price in hopes of a profit. Then we have buy. Buying is purchasing an asset expecting it to rise, right? It opens a position or increases the position if you're adding to it. Then we have longs. Longs is owning an asset with an expectation for it to gain value. So when you get into a long position, you're betting that the price of the vehicle is going to go up. So buying, you're opening or increasing a position. And then if you're in a long position, that allows you to profit when the price of the stock or the vehicle goes up. All right, so we got Candlesticks 101. Candlesticks, and this is my own definition, the best way that I feel like it's explained or defined. Candlesticks are a visual representation or picture of a stock's price and volume within a time frame. So there are 3 key factors here. There's price, time, and volume. And the reason why candlesticks are so important is because, like I said, it's a visual representation. It's a picture. Imagine if I started giving you a list of prices that the stock has, hit in the last, let's call it 4 hours. And I say, okay, $1.25, $1.07, $1.35, $1. $2.50, and I just give you these lists, like a list of prices. It's going to be very hard for you to predict the next price, and it's going to be very confusing, right? But what if I actually gave you a chart with pictures or images or shapes that form a pattern of that same list of numbers that I gave you? It will be way easier to predict the next price movement because at that point, you don't even necessarily need to know the numbers. You could just look at the patterns. And that's what I do. I could not tell you exactly what price level or anything. I just look at patterns and I trade them. So if you look at this infographic that I made, you see that there's a bullish candle and then there's a bearish candle. There's a couple pieces that creates, or a couple components that create a candle. We have the high. I'm going to look at the bullish candle first. So we have the high, the close, the open, the low. Then there's actual parts of the candle. You have the body and the wicks. The wicks actually shows the range of the highest price point and the lowest price point within a certain amount of time. And then the body shows where we closed at and where we opened at within the same amount of time. And that time, in that certain amount of time, is called time frames. So if we're on a 2-minute time frame, each candle is going to represent the range of price that the stock went within 2 minutes. And if you look at the bullish and the bearish candle, the only difference between these two is the open and the close. So since bullish is going up, of course the open is going to be at the bottom as price increases and then close within that time frame. And then you see the bearish candle. And of course, since it's bearish, it's going down, the price decreases. The open is going to be at the top as the price decreases and closes at the bottom. That's the only difference. And then I have a legend at the bottom if you want to screenshot it. And it's also good to know that each individual candle is not enough to tell the story or to guess where price is going to go. You need pretty much a collective of candles. All right, so moving on. Like I said, candlesticks are a visual representation of a stock's price and volume within time frame. There are 3 key factors: price, time, and volume. So let's talk about the three key factors. We have price and volume. Price is how much the stock costs. Volume is how much strength is behind a price move, no matter if it's bullish or bearish. And the amazing thing about price and volume is that they are the only leading indicators. A leading indicator helps you guess where price is going to go next, where lagging indicators such as MACD, moving averages, RSI, all those things, those are lagging indicators, which means price and volume have to occur first in order for those lagging indicators to get that data from the price and volume and then give you a signal. So in other words, it's lagging. That means the price or the move has already happened by the time you got the information to make your decision. So it's too late. So that's why if you ever go on like my Instagram, follow me on Instagram, Lawrence the Investor, if you don't already. If you go on my Instagram, you'll see my live trades and there is nothing but candlesticks on my chart, because any other indicator is not going to help me guess what price is going to move, because it's collecting the data from the price move that already occurred. All right. Only trade price action and volume. Only use indicators based on price action and volume, such as VWAP. VWAP is the only indicator that I actually do use, but like I said, it's based on price and volume. Even if I take VWAP off my charts, I could still trade with just, normal candlestick patterns. So candlesticks shows us two things: edge and history. You have to have an edge in the game to win over a long period of time. And then it also shows history. It shows a clear history of how a stock's price have moved over time. And this helps validate our edge. So therefore, backtest, backtest, backtest. I cannot express that more. You play how you practice. So make sure you backtest a lot to a point where you got your strategy down packed, and then you can go into the live markets. And then the last key factor is time. A time frame is how long each candlestick represents price movement. And here's a big tip when it comes to time frame. It's always best to switch to a lower time frame on a highly volatile trading session, and it's always best to switch to a higher time frame when there's choppy or a low volatile trading session. And that's because if we're in a highly volatile market, you want to go to a lower time frame so you can actually catch an entry. Because if you go to a higher time frame on a very high volatile market, price is just going to keep pushing and you're pretty much going to miss the move. Where if you go to a lower time frame, it actually gives you an opportunity to get in. And when we're in a low volatile market, it's best to go to a higher time frame so we can see the bigger picture, while on a lower time frame, price action is going to look very choppy and you don't want to trade that. So always go to a higher time frame so you can see the bigger picture. Then you can enter, and it may take a little bit longer because we're chopping around, but eventually the move will come. And normally the longer we chop around, the bigger the move will be, or the more volatile the move will be when it's time for a breakout to occur. Now I'm going to connect the three key factors of a candlestick with the three goals of a trader. So the three key factors, like we said, is price, time, and volume. And then the three goals of a trader is direction, timing, and target. Okay? So our job is to predict the next price direction. Okay? So our job as a trader is to predict the next price direction. Time the best entry by using higher time frames to spot the trends, and lower time frames for precise entry. And once the trade is entered, wait and see if there's enough volume to push the price to one of our targets, no matter if it's our profit target or our stop loss. It has to reach one or the other. And one of the most important parts, keep your hands off the mouse, walk away from your desk, whatever you need to do to not interrupt the trade until one of our targets is hit. Less is more. And here's a quick little rundown. Price increase equals direction is going up. Price decrease means direction is going down. Higher time frames help you identify the overall trend, while lower time frames help you with precision entry. Volume equals strength behind the price, and this is the movements that we need to reach our target, if it's either our profit target or our stop loss. All right, so moving on. Okay, so we have bulls versus bears. And I want you to keep this in mind up here. We're only going for high probability shots. Nothing is guaranteed. You can never take the uncertainty aspect or the gambling aspect out of trading. So we're just going for the highest probability trades, the things that keep the odds in our favor. So each candlestick shows the battle between buyers and sellers during a specific time frame. If the close is higher than the open, buyers were strong, and that gives us a bullish candle. If the close is lower than the open, sellers were strong, and that gives us a bearish candle. This is the foundation of it, but it's not enough to determine the actual trade itself or our bias of what direction price is going to go in overall. So in order to do that, we need to spot trends. We want to look for multiple candlesticks moving in one direction to identify the trend. And if you look at the candlesticks down here, you can see overall we're going in an uptrend, even though we have a few bearish candles right here and right there. They're very weak. We can't just go up forever. It's just not going to be a straight shot. So it's okay to have these dips. It's very healthy, right? And I will go on to say that, when we have dips like this, that allows the market to breathe and push up even higher versus going straight up. That normally expresses exhaustion and a reversal may be coming. Just like up here, we have a higher high up here, another higher high, then we have a low right there, and then a higher low. So if we wait for each candle to close, which is the most important part, by the way, always wait for a candle to close, we can see what trend we're going in. And then we have the downtrend, a series of bearish candles with lower lows and lower highs. So we have a high right here, a low right there, a lower high right here, and a lower low right there. Always wait until the candle closes to identify the trend. So pivot points 101. 3 candle formation indicating a reversal or stop in trend in real time. A lot of times we don't notice the trend until it's already over in hindsight and the move is already gone. But this three candle formation, this pivot point, is going to allow us to see it coming in real time. And once again, this is just high probability approaches. None of this is guaranteed, so always manage your risk. Pivot points are like checkpoints on a price chart based on past highs, lows, and closes, showing where the market might stop to turn around or just push through. So how do we use pivot points? Pivot points actually identify and allows us to spot supply and demand, support, and resistance. They're also very good, and I use them to set my entries and exits. And lastly, they can actually confirm a trend or a breakout. So here's an example of a bullish pivot point, right? So a bullish pivot is a reversal to a bearish trend. So we have a lower high, the highest high, and then a lower high. So we're going up and then we come back down. Remember, we want to wait until the close of all 3 candles, okay? So wait until it closes. Do not assume because you have no idea if we're going to continue to go up or not. So wait for the close of all 3 candles to confirm a pivot point. Then we have the bearish pivot, reversal to the bullish trend. We have a higher low, the lowest low, and then a higher low, right? Wait for all 3 candles to close to confirm this pivot point, and this is your heads up to know that we're going into an uptrend. And the reason why this is so important is because if you can identify the major trend, and how I identify it is going to the 5-minute chart, waiting for 3 candles to close, strong candles to close in one direction, then going to a lower time frame such as the 2-minute and looking for a pivot point for a pullback. Once I see a pivot point for a pullback and then another pivot point to continue in the trend's direction, I'm in the trade. And the low of the pivot point, if we're in an uptrend, will be my stop loss, or the high of the pivot point, if we're in a downtrend, will be my stop loss, okay? All right, so we're almost to the end. Here are some actionable steps, things that you can take with you and start working on immediately. So to help us predict price direction, we have to confirm a trend on a higher time frame. Then we have to guess when will price continue to go in my direction and time the entry using a lower time frame. And lastly, we want to set targets you can actually hit using the stock's current trading volume. So how do I do each one of these? Here are some ways to confirm a trend. 1, you can go to a higher time frame. You can use the 3 soldiers candlestick pattern, which is 3 closed, very strong candlesticks going in one direction to confirm a trend. And that's one way to confirm a trend. The second way you can confirm a trend is wait 30 minutes to avoid the morning reversal trap in the New York session. So when the stock market opens up at 9:30 in the morning, that's normally the most volatile. So wait out the first 15 to 30 minutes, I would say 30 minutes just to be safe, to make sure that there is no morning reversal. And after that 30 minutes, you will see the trend for the day. So once we identify the trend for the day, now we need to time our entry, right? So we need to wait for a pullback, wait for a low risk opportunity to enter with good reward. So we need a precise entry. We want to wait for a pivot point on the higher time frame and then switch to a lower time frame. For me, I'm always on the 5 minute, but when I'm ready to enter on a trade and use my precise entry, I go to the 2 minute or the 1 minute. So when you go to a lower time frame, it has to be at least half of the higher time frame that you're using to confirm the trend. I wait for a pullback or a consolidation period to lower my risk, and then I enter the trade on a breakout or a retest to lower the risk of a fake out. So how do I set a target that I can hit based on today's or this trading session's volume? So 3 different ways to plan your exit. You can use the average true range, and an average true range is an indicator that you can look up. And basically what this tells you is the average price range that specific stock or vehicle reaches within a certain time frame. So for example, say if I'm on the 5 minute time frame and I look at the average true range, and the average true range for ES or SPY on a 5 minute time frame is $1. That is the average move that you're going to get when you enter a trade before a reversal. So to be safe, if the average true range is $1 and that's the average, I might go ahead and put my profit target at 75 cents. Or I could put my stop loss at $1 to 75 cents. So then we have supply and demand. Supply zone is an area of interest where big money and big institutions begin to sell their position. And a demand zone is an area of interest where big money and big institutions begin to buy and increase the price as a result. And then the last form could be high or low of day. If we're in an uptrend and we just pull back, the high of the day can be your profit target when you're entering on a pullback. Or vice versa, if we're in a downtrend. If we're in a steep downtrend and price pulls back, you can enter, and then the low of the day could be your profit target. All right, so here's an example of a bull flag. This is one of my favorite setups that I normally trade, and I'm going to explain it to you using everything that we learned in this segment. All right, so first, I'm on a higher time frame for me. I normally use the 5 minute chart. So I have a confirmed uptrend. I'm allowing price to rip and continue to go higher until I see a pivot point, which is my sign or my heads up of like, hey, Lawrence, we're about to go back into, we're about to pull back, retrace, or it may be a reversal. And because this is all odds and probabilities, I'm going to manage my risk, because even though we're in a confirmed uptrend, that does not mean a V-shaped reversal cannot happen and we go straight down. Whenever I see this consolidation period in a trend, I always look at it as the value of 0. So if we're going up, right, in a positive way, we're going up, this is still 0. This is, I don't even pay attention to this. This counts as 0 value, and it's not interrupting the trend. So we're going to continue to go up. And that's how I look at those consolidation periods. Then once I see this pivot point and I get that heads up that we're about to either retrace or reverse, I manage my risk. Then I go down to the 2-minute chart to prepare myself for entry. So this is the same uptrend on the 2-minute chart that we see on the 5-minute chart. Now this is the same pivot point right here that we see on the 5-minute chart. We begin to come down. So I know that this is most likely going to be a retracement or a pullback because all of these candlesticks are very small and choppy. Okay, compared to like big candlesticks like this one, right? So this is choppy and small. So as we're going in the downtrend, I see another pivot point that may continue, that gives me a sign like, hey, we're about to turn around and continue to go into the uptrend. So we have a low, lowest low, and then a higher low. And once that happens, I know that this low point will be my stop loss just in case I'm wrong and this is a V-shaped reversal. So this is me protecting myself right here at the lowest pivot point. I'm going to enter once we break out right here of the higher day. And then I'm going to let it ride all the way to my profit target, which is the average true range of $1 from my entry. So $1 from right here, my entry, the high of day, is my profit target. My stop loss is going to be with the lowest point of my pivot point in the bullish trend. This is my bull flag, and then I do nothing. I wait. Once I enter, I wait. You're either going to hit my profit target or you're going to hit my stop loss. No matter what, I manage my risk and I played my part. This is now a one trade, no matter the outcome. I hope that example helps you out. I hope it made sense. If you guys have any questions, comments, concerns, put it in the comment section. I'll get to it as soon as I can. And you guys have a happy holidays.